Welcome back to another episode of Milkshakes Markets and Madness. It is Saturday, June 14th, and tomorrow is Father's Day. So, big happy Father's Day to all the fathers out there. Today, we are going to talk about the dollar. Surprise, surprise. And the reason we're going to talk about the dollar is this is a show where we talk about the financial markets, the madness surrounding those financial markets, and we do it all through the lens of the dollar milkshake theory. And the dollar had another tough week this week. And so, of course, like always, whenever this happens, I got tons of emails and text messages and Twitter DMs saying, once again, this is it. The dollar is dead. The dollar's on death's door, and it's only a matter of time before it completely collapses. So, what we're going to do today is we're just going to kind of walk through it. And I'm going to show you some of the stuff that I look at and what I use that for to kind of help me figure out what's going to happen going forward. And the first thing I will say is that maybe the dollar will go lower. I don't know what it's going to do on a day-to-day basis or a week-to-week basis. Maybe the dollar will continue to fall and, it'll go back down into the mid 90s or even the low 90s. But my answer to that would be, okay, that's fine. Every time that happens, asset prices do really well. And since we manage assets and we own a bunch of assets, they will go up and to the right because that's what typically happens. Now, is it possible that both the dollar and asset prices fall? Sure, it's possible. Very unlikely, but it's possible. But we own real estate, we own gold, we own other hard assets. It's hard to see the dollar falling significantly and those going down at the same time. Again, is it possible? Sure, it's possible. But the milkshake theory, it's important to understand what it actually is. The milkshake theory is a framework for understanding how markets might react in a sovereign debt crisis. If we go into a sovereign debt crisis and we stay in a sovereign debt crisis, and throughout that period, the dollar falls and never rises, and then a new system gets brought on board while the dollar has been falling, then the milkshake theory will be proven incorrect. But we're not currently in a sovereign debt crisis. It's getting closer, and it seems like all the signs are there that we will enter one, but so far we haven't. But the fact that we have not entered yet a sovereign debt crisis, and yet the overall framework of the milkshake theory has played out and helped understand why markets have reacted over the last 5 or 6 years is extremely helpful. So again, what it said at the time was that this was not 2018, 2019, that after a 40-year bond bull market had run its course, we thought it was time for interest rates to rise. And when interest rates rose, then bond prices would fall. And that includes US Treasuries and other sovereign bonds around the world. And as those interest rates rose, the dollar would go higher as capital flowed into the United States. And that would simultaneously push US asset prices, specifically US equities, a lot higher. And gold would go higher as well as sovereign bonds got repudiated. And if you look back at a chart over that time period, bond prices have fallen, interest rates have risen, the dollar has gone up, US equities have gone up, and gold has gone up. So the framework has really helped me understand why asset prices have done what they have done. Now, has the dollar gone up in a straight line? No, but the DXY was like 88 or 89 when I first started talking about it. Today, it's at 98. So it's up 10% over 6 years, which is not an amazing return. And nobody is suggesting that you should just be sitting in dollars. But for a currency to rise 10% in 5 years, especially when everybody else is always calling for its death, not too shabby. So that's where we sit today. But the dollar is also down about, 8, 9, 10% year to date. And it was down significantly in April, bounced a little bit, and now it is back down at its lows. And again, so many people think it's heading lower. The reason it was down so much this week was we had both CPI, which came in low, and PPI, which came in low. And as a result, the idea that interest rates would continue higher or that the Fed may be closer to cutting took center stage. And because currencies move on interest rates, the dollar fell. And that brought out, again, all of the dollar bears. So let's take a look at some of the things that we can help us figure out where we go from here. So the first thing I'm going to show you is this. Now, you guys have seen me post this before. This is just a, I don't know Jake. This is just a service I subscribe to, but there's many of these different types of services out there, and this is basically one which just it basically ranks different assets as far as sentiment, and the range is from 0 to 100. And I use it at the extremes. When sentiment's kind of 50, 60, even 70, maybe it doesn't mean a lot. If it's 30 or 40, maybe it doesn't mean a lot. But when it gets to the extremes, it actually is very helpful, especially if you use it in conjunction with a number of other signals, right? And so, the bands that I kind of think about is if anything above 80 or below 20 is signal worthy and something to pay attention to. If it gets above 90 or below 10, well, then that is something where I just have to act regardless of what is going on. And so if we look right here, let's find the dollar. The dollar index is at 23. Okay, now that's Friday. It closed at 17 on Thursday, but it was down a lot more in the morning than where it closed. So probably real time on Thursday morning, it was probably like 12 or 13. So that's not below 10, but it's about as close as it can get without being in extreme territory. And when anything gets in that extreme territory, whether it's 90 or 10 or whether it's really high or really low, then that indicates to me that we're either at an inflection point or getting very close to one. And then we got to look at the reverse too, or the inverse of that, right? Let's look at the British pound and the euro. Well, the euro's at 77, but that's Friday. On Thursday, it was at 81, and intra-morning, I'm guessing it was around 85 or 86. Again, very high. The pound didn't get quite that high. It was it's a 70 and closed in the 60s then, and the Canadian dollar kind of in the 60s. So it's really the euro that was getting the majority of the flows against the dollar. At the same time, we see gold up here at 81 and 76 on silver. That's mainly as a result of the events in Israel and Saudi Arabia. I'm sorry, Israel and Iran over the weekend. But anyway, we're at pretty extreme sentiment readings on the dollar. So that's one thing to keep in mind. Now, the other thing to keep in mind is here's another sentiment gauge. So there's different ways to, and like I said, there's many different services, but this is another one. So this shows the FX exposure and basically the view of, some different bull bear scenarios and surveys. And it basically shows that U.S. sentiment is as low as it's ever been in history, right? Now, positioning has not yet got the lowest ever, but it's getting close, but the sentiment is the lowest in 12, 15, 13 years, as long as this has been around. And then another one this is just a way to look at the positioning. And again, the positioning, it's not totally extreme, but it's about as low as it was in May of 21, and it's about as low as it was in May of 23. And you can see the gray line here is the chart, or is the DXY, and you can see what did the dollar do after each of those times that it was that low. So again, there's no guarantees that the dollar turns and goes higher here, but it would be pretty extraordinary for it to continue down in a dramatic fashion from here. Again, possible? Of course it's possible. But again, let's remember, what does the direction of the dollar mean? The direction of the dollar means that if the dollar is going lower, that means there's plenty of dollar liquidity. The only way to increase dollar liquidity is because money is loaned into existence, is to increase the amount of debt in US dollars. So as credit is extended, as more debt comes online, that provides more liquidity and the DXY price falls. But that debt creates a future obligation and future demand for dollars. So as the DXY falls, that's re-dollarization. That's not de-dollarization. And that is why I always say de-dollarization and a transition to a new system will come with the dollar going higher, not lower. So as the DXY goes higher, that creates the chaos, that creates the pain, that creates the forced deleveraging and de-dollarization. So if the DXY, continues down into the 90s or even into the 80s, that just kicks the can down the road all that much further, and it makes the eventual spike all that much higher. So that's something to keep in mind as we get to these extreme sentiments. Now, give me 1 second. I'm going to remove this and I'm going to bring something else up onto this. Nope, hold on. Hold on. I'm going to try to bring up my screen if I can do this. Almost there. 1 second. Okay. So now we're just going to go through some charts and we're going to look at things a little bit closer. So this is the DXY year to date, basically, and you can see it's been a pretty consistent move lower with a couple dramatic weeks along the way. Now this is daily charts, but you can see there were some pretty significant moves, and so now here we are at 98. It was down Wednesday on CPI. Down again Thursday on PPI. It had a bounce on Friday due to basically due to risk off scenario. But I have to say, like, Friday was a really weird day. Some people would say it was weird because money didn't rush into treasuries, didn't rush into the dollar. And I agree, but but overall, all markets were pretty muted. I mean, gold was up, but honestly, I would have expected gold to be up more than $30 based on Israel bombing Iran. And, equities sold off, but not dramatically. And, the VIX jumped to 20, but that's high, but it's not totally dramatic. Silver didn't do a whole lot. Copper didn't really react that much. The one market that did react a lot was oil. So oil was up like 7, 8, 9%. So that was a big one. But it was just kind of a weird end to the week, especially with all the drama that was going on militarily. But okay, so this is the dollar. You can see kind of what it's done year to date. Now we're gonna zoom in a little bit, or we're gonna zoom out. Sorry. So this is the DXY going back about 20 years, 15 years, and this is a yearly chart. And the reason I'm going to show this is I just want to show on a technical level where the support is. And it is around the 96 level. So we're around 98 right now. So we're not too far away, 1 or 2% away from support on a yearly chart. Well, let's look at a quarterly chart. Let's look at a quarterly chart over the same time period. Okay, so this is a quarterly chart, right? So if we do a quarterly chart, boom, 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 we kind of get about the same answer. We've got support at around 96.50, something like that on a quarterly chart. Oh, let's change this. Let's look at a monthly chart. Okay, here's a monthly chart. Again, we've got support right here around 96, 97. Then we go to a weekly chart. Kind of the same thing again. Let me zoom out here so you can see it better. All right. Hold on. So going back 15 to the weekly chart, the weekly support is around 96, 97, right? And if we go to a daily chart, I'm going to have to zoom out more than this. Give me a second. Let's see here. So again, we've got support pretty close, right here, kind of the 97, 96 range. So the point is can it go through this line? Of course, it can absolutely go through this line. But again, if it goes through, I'm not worried about the DXY going through that line. I'm worried about the dollar spiking and wrecking everything. I'm not worried about the dollar falling and providing liquidity to the world. Liquidity is what markets need. But we have extreme sentiment. We're getting close to extreme positioning, and we have support very close to here on both a daily, weekly, monthly, quarterly, and a yearly level. Now, again, does that guarantee that it bounces? No, but I'm just pointing out that everything is very lopsided right now. And a lot of it, in my opinion, is being done because of the delay in the tariffs and everybody that believes everything's going to be fine and there's not going to be any more volatility for the rest of the year. And I just, I fundamentally think that is wrong. Okay, so then let's start looking at some of the other stuff that we look at. We often will look at the stock prices and we'll look at this chart that shows, the stochastics and the RSI. So this is showing the RSI on the DXY. It's actually not that. This is over a 5-year period, right? So if we went 1 year, it changes it a little bit, but not dramatically. Let's just zoom out and do the 5-year because that gives us a pretty good time frame. So again, not totally dramatically low on RSI 35. It's low, but not extreme. But stochastics are, single digits. I mean, in the very short term, it's extremely, extremely oversold. But then, when you talk about fiat currency versus fiat currency, you got to remember it's one side of the same coin. It's a zero-sum game. Fiat currencies are a zero-sum game. If one currency is falling, then the other currencies are rising. And the DXY is an index that's the basket that sits against basically 5 other currencies, right? The euro, the yen, or 6 other currencies: the euro, the yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. So let's look and see what those look like on the same chart. So this is the euro. Again, not extreme. It's obviously had a huge run up here. It was very overbought back in April. It had a pullback. And you can see the stochastics were very high back in April, had a pullback. And now we're back up. We're not quite to overbought territory, but getting close. Pretty similar to the inverse of the dollar. The dollar wasn't quite in oversold, but very close. But the stochastics are, again, very high on the euro. If we move to the yen's kind of in no man's land, 50 range on both of them. So that's not, that doesn't seem to be playing a big role, or at least it's not giving us a lot of signal right now. The pound, again, it's high, but not significantly. It's more of the stochastics than anything, which may be warning. Maybe we get a little bit of a pullback or a slowdown. We move on to the Canadian dollar. The Canadian dollar is actually more overbought. It's pretty close to overbought territory, both on the RSI, and it's definitely overbought on the stochastics. You can see it's at 67 on the RSI, and it's around 95, 96 on the stochastics. Moving on to the Swiss franc. Again, kind of no man's land as far as relative strength. The stochastics are pretty high. And then finally, the Swedish krona. Kind of no man's land, not giving us a whole lot of signal value. So what does this tell me? That tells me that things are getting close to extreme, but they're not yet extreme. The dollar, the DXY was in the 20s and then the teens. It wasn't quite into single digits. The euro was in the 80 and pulled back to 70. So it was over, it was high sentiment, but not totally extreme. And a lot of these others are getting close, but not there yet. So that tells me, the DXY is at 98. We saw a bunch of support around the 96, 97 range. So is it possible over the next week or month or something, we go down and we kind of test around that 96, 97? Yeah, that's easily possible. And to be honest, it wouldn't bother me at all if it does that, because, well, first of all, if it continues lower, that's no problem for all the reasons we've already talked about. But if we do get down to those levels and then the sentiment levels get to the really extreme, then that makes the decision actually pretty easy what's going to happen next. Right now, because we're not quite at all the extremes, it's not super easy, and it's not super easy to say the dollar's immediately going to rocket higher. But the other thing I will say is those extreme numbers, they just don't happen very often. That's why they're so great. Is because when they do happen, because they're so rare, which way it's going to go, or at least you have a very high degree of confidence which way it's going to go, because they just don't go to that extreme very often. And when they do go there, they don't stay there for very long. So that's kind of where we're at on that. So, but because we don't often get to those very extreme levels, and because we've already pretty close to the extremes, and now, this is the whole Israel Iran thing is a big deal. I probably don't have to say that, but it's a very big deal. Not because it will definitely create chaos, because maybe it won't. Maybe we'll come in tomorrow night and all of the major activity will be over by then and futures will be green. I don't know. It's just that this has the potential to not just be volatile, but be extremely volatile. And then you combine that with Well, let's just look at some of the asset prices and some of the different things that we look on the same scale here, right? Let's just look at the VIX. Again, I don't necessarily do technical analysis on the VIX, but the point is, you know, as far as kind of relative strength, it's kind of no man's land, but the stochastics are very low. And as of a couple days ago, it was pretty oversold, and the stochastics were like at 2 or 3. So now it's had a little bit of a bounce, but this is, I mean, for what's going on in the Middle East, this is nothing. I mean, this could easily be up here within 24 hours. And I would expect the dollar would probably get a bid if that were to happen. But the other thing is, we have highlighted several times over the last couple of weeks how markets had gone from one extreme to the other extreme, and now they're back at the other extreme again. So let me just pull up the S&P 500 here. This is the SPY, but the same thing. So again, last summer, a year ago now, we were very extreme overbought. We had the hard sell-off. We ran back up early into the year. We were extreme, or we didn't quite get to the extreme overbought again, but then we had the really hard sell-off. We got extreme oversold. We knew there would be a bounce. I thought it was going to bounce into late May. I didn't think it was going to still be this high into middle of June, but here we are. But again, as of, just a couple days ago, we were kind of very close to the oversold territory, and the stochastics were really, really high. They couldn't have gotten any really a whole lot higher. And that was on the backs, and that was without what's going on with Israel and Iran. And we had some risk off on Friday as that was breaking. But let's look at again. We talked about Microsoft last week. Now look at Microsoft. It kind of extended it even more. But look, I mean, it's very overbought. Its stochastics can't really get any higher, and it's kind of sitting at an all-time high. Again, I just still think that Microsoft is due for a pullback. Now, whether that happens this week or next month or next quarter, I don't know, but I don't think this is rocketing to 550 without a pullback. We'll have to wait and see. But let's look at semiconductors, because semiconductors were also extremely overbought. They, again, just as a couple of days ago, they were overbought both on relative strength and stochastics, and then Friday they had a pullback. So, with the dollar being near its extreme, with asset prices being near the other extreme, with the euro being near the extreme, maybe last week was the inflection point and we go the other way. But if not, I don't think we go more than another month. Maybe the dollar goes down into July. Maybe asset prices stay fairly strong for another month. But I think by the time we get into if we don't have it this week or next week, I think by the time we get into kind of middle of July, then we're going to have an inflection. And I'm going to end it on this, and you guys are going to laugh. But those of you who have been following me long enough know there's another signal that I look at, not on its own, but in conjunction with everything else. And it's actually done very well for us over the last 12 months. And it's coming up again in the middle of July. So I would imagine the middle of July will either be a high in the market or a low in the market. But I do think there will be an inflection point in the middle of July. And we'll talk about that when we get there. In any case, that's where we're at. Dollars on death's door. Everybody tells me it's the end. I wouldn't bet on it. I still think that this plays out with the dollar going higher. But that's what makes a market. Anyway, hope you guys have a great weekend. Happy Father's Day. And we'll talk to you again next week.